Welcome to the Commercial Real Estate Show. Thanks for joining us to lead, learn, and laugh. I'm Michael Bull, your host to the world of commercial real estate. Thanks for joining us today. Well, today we're discussing retail and retail real estate. We will look at ways retailers and landlords can maximize leasing strategies. We'll look at the state of the retail investment market, and we'll look at some best practices to sell retail properties. Please welcome my first guest, Dan Fasulo, Managing Director, Real Capital Analytics. Real Capital Analytics provides transaction intelligence, trends, and tools for the global investment real estate market. Dan, thanks for joining us today.
Thanks for having me, Michael.
Well, Dan, how did retail real estate sales volume and cap rates end up in 2013?
2013 was a great year, Michael. We recorded about $60 billion worth of retail sales throughout the year across the country. That was up about 7% year over year. Not the best performing overall versus some of the other property sectors, but certain segments of the market, like strip centers, did outperform. Actually, the sale of strip centers was up 26% year over year.
And that's great. And what do you see for cap rates?
You know, this recovery wasn't even over the last few years, and retail, I have to say, was one of the laggards, at least kind of your bread and butter strip center. So this significant spread opened up between, let's say multifamily, central business district office, and then some of the other property sectors, and that spread really drew capital to retail over this past year, and we did see some nice cap rate compression, down 20, 30 basis points throughout the year. And keep that into context as well. That 20, 30 basis point decline is with the kind of 100 basis points pop we've got in interest rates.
Yeah, that's interesting. So what are some cap rate examples for, say, a Class A core asset or maybe even a B retail strip center somewhere?
Nationwide caps are averaging around 7% for your kind of core Class A property that many of your viewers deal with. You're looking at 6% or below in some of the major markets around the country.
Yeah, that's great. It's good to see that retail's coming back. And so institutional participants, they also they like retail now? They're not afraid of it anymore? They're looking for that yield?
Well, what's amazing to me, and a real sign that the market has gotten healthy again, is the diversity of participants out there acquiring properties now. It's not just one capital group. We're really seeing action from a whole host of different parties, including the institutional investors like pension funds and insurance companies that have returned, but also from REITs, both the public REITs and the private REITs, which have been gobbling up smaller single-tenant properties around the country. And then, partly fueled by the resurgence in the CMBS space, the private investors are back in a big way. This was a group more locally based that was having trouble accessing debt capital a couple of years ago. We talked about it on this very program.
Yeah, that's interesting. And we're talking with Dan Fasulo, Managing Director with Real Capital Analytics, about retail investment properties. And, so what do you expect moving forward into 2014? Do you think these cap rates will remain stable because interest rates may increase a little bit, or do you expect a little more compression?
So no one's going to bet that interest rates are going to go down this year. So in that context, there's going to be some headwinds against ever compressing cap rates. That said, yields for retailers still attractive versus some of the other property sectors. We're seeing all-time record low cap rates for multifamily right now, and the higher yields in retail are going to continue to attract capital, both on the equity and debt side, and in my experience, when capital is hitting your segment of the market, your prices are going up, and I think the real story for 2013 was the expansion of capital from kind of the primary markets to basically everywhere around the country, and also into your more challenged properties, properties that needed work, lease up type strategies implemented. I expect that spreading out of capital to only accelerate in 2014, and I think many owners that have been waiting for that capital to come ever since the financial crisis could be in pretty good shape this year.
So it sounds to me that you feel that cap rates could compress a little, possibly for retail in 2014?
It's not the common view, but I'm going to go out on a little limb here and say that we will see some additional cap rate compression, in spite of a slightly higher rate environment.
Well, it makes sense because it seems to have the best cap rates for a buyer than the other sectors right now, and I'd much rather have a 6 cap in a retail property than a 4 cap on an apartments, I think.
Well, remember too, Michael, our fundamentals, rents and vacancies for retail haven't fully recovered yet like they have for multifamily. So we have, there's certainly room to run on the NOI side. And that could be, somewhat of a counterbalance to higher interest rates.
Right. Yeah. There's still great upside on a lot of the retail properties. That's a good point because our rental rates aren't really where they might. The rates might go up a lot in the next couple of years. I mean, there's been such a lack of new construction that could really help. And you talked about secondary markets and tertiary markets. You're seeing more activity there. Do you expect that to continue?
Absolutely. I mean, that's. That was where the big gains in investment activity were, year over year. Places like, Las Vegas, Phoenix, even, places in the Midwest like Columbus, Ohio, Texas has been really hot. Actually all through the Sun Belt we've seen, big gains in activity. Whereas, the major markets have been, relatively, flat year over year and have almost basically recovered to their, pre-downturn levels of activity. Part of the issue in the major markets is, we're hearing it from our investor clients, is just the lack of supply on the market to buy.
Yeah, that's a good point. And you mentioned these markets doing better. So is there any distress left in the market out there?
We're certainly moving into the later innings of the distress cycle. According to our stats, we're about a little under 70% worked out, of the trouble. The remaining loans that have defaulted are mostly with CMBS lenders. About 2/3 of the distressed loans are with CMBS, and I'm sure you've dealt with that backlog in the past. So I'd say we're in the 7th inning of the ball game, if you will, and from the percentage of distressed sales as a percentage of the overall market, we're down below 10%. So we're well past the point where these distressed properties are having a material impact on the investment market. They could be causing some local, space market issues, but on the investment side, the game's pretty much up.
I see. Okay. Well, where do you see some opportunities in the marketplace?
Yeah, I think the investors that have the teams on the ground that can really reposition a property, given asset capital, execute a lease-up strategy, and then exit and sell to those institutional investors that are waiting for the pretty assets. I mean, that's the play in 2014. It's that part of the cycle. I think if you're bull charging into core properties with fixed income over the next 5 years, I think those are the assets that could get hit the highest, the hardest in a higher rate environment.
Well said, Dan. Thanks for joining us today. We appreciate it.
Thanks for having me.
For more information from Dan at Real Capital Analytics, visit rcanalytics.com. I'm Michael Bull. It's a Commercial Real Estate Show. We'll be right back. The Commercial Real Estate Show is brought to you by Atlanta Office Liquidators, new and used furniture liquidators, France Media, publications and conferences, and Bull Realty Commercial Brokerage, a great place to do business. For more information on these companies or to access additional podcasts, videos, or blogs, visit commercialrealestateshow.com.